So, welcome everyone. We got Dan Patton here. I mean, the topic of conversation in the last couple of weeks has definitely been about interest rates. I'm sure Dan is sick of talking about it. So, I think we're going to do a call, and we'll record it, and this way, a few hundred people can listen to the answer. No, but it's totally human to be asking these questions. This is what happens when the market, has a little. I shouldn't say a little, a decent size shift. You kind of want to know what's going on and get your bearings before you make decisions about what you want to buy, what you want to sell, what you want to hold, what you want to refinance, and what you want to do. And that's what we want to do, is provide that guidance for you. So we had over 140 people register, which was fantastic for Thursday. I'm glad nobody's at work, or everyone's sneaking away at work to listen to this. So feel free to type your questions in. We're going to leave this like an open dialogue, and I'll just kind of prompt Dan with some questions that I know we're all getting. So first, let me welcome Daniel Patton at BM Select. He's been doing our financing for, I don't know, 10 years, maybe more. So
maybe longer.
Yeah, longer. I know he's been doing it longer. He knows his stuff, and that's why I like to bring him on. He's got a real macro perspective he does well explaining it, and but he's working on the deals every day, so he sees stuff that's going on a day-to-day basis, and I take his word for it. So welcome. Thank you, buddy.
Thank you, Paul. Like I said, Paul and I are, for those that don't know, Paul and I have been doing business for a long time. We're friends outside of this. So it's a pleasure to be on any webinar that you're doing with any of your clients. I see a lot of familiar names. So I'm glad. Hopefully I can, so a lot of the time my relationship with the client ends up being either on the phone or through email. So I don't get a lot of FaceTime. So it's nice to actually see everybody and kind of answer everyone, any questions that people have. Because you're right. It's, there's a big change. I mean, we haven't seen a change like this in prime rate going up. We've seen it go down quickly, but we haven't seen it increase the way it did, with more potential increases looming. So it's a really good opportunity for people to, ask their questions, get an understanding of how do the real numbers work? How does this affect my payments? What are things I can do to offset that? So no, thank you for having me, man. I appreciate it for sure.
All right. So let's just step back and let's do a quick review and let everybody know what's happened. So a few weeks back, we had the first interest rate hike. Canada raises prime rate a quarter point, which kind of didn't do much. And then most recently, they raised it a full half point, which they haven't done a full half point in like 20 years. And that's really at least one of the main culprits for putting a real wrench in the way the market's been moving. We on the same page?
Yeah, definitely. So prime rate, they were going to actually, at the beginning of the year, the rumor was they were going to raise it at every increase. They thought about increasing it, but when Omicron sort of reared its ugly head and the numbers started to go up, they actually decided to leave prime rate where it was at the first meeting. It wasn't until the April meeting where they decided to increase it half a point. So prime went from 2.7% to 3.2%. Now, just so everybody understands, when that happens, it's an announcement. It doesn't happen overnight. It's an announcement. And that prime rate usually takes effect at the beginning of the next month, at the beginning of the next monthly cycle. That's where you'll start to see that mortgage rate change. So 2.7 to 3.2% from a numbers perspective per $100,000, Paul, that's about a $30 increase, right? So if you're talking a $300,000 loan amount, you're talking roughly $90. Now that might vary just a little bit, but that gives you a bit of an idea of the difference. But yeah, shocking, right? We all knew, fixed rates have been steadily increasing. I don't know if that really made its way to the public, really. When these announcements happen, about prime rate, that sort of is, what hits the headline news, but fixed rates are a bit more sensitive. They moved up months before. Yeah. So just to rewind, let me explain the difference.
I was just going to say, let's explain the difference quickly for those who are, a little bit cloudy on it, the difference between a fixed and variable and how they're calculated for everyone in Canada.
Right. Yeah. So just to rewind, exactly right. So a fixed rate from a bank has really nothing to do with variable rates, okay? Fixed rates are based on the cost of the bond from a bank. So fixed rates go up, they go down. Bonds are sensitive, right? In pricing, they move up based on rumor. They can drop based on rumor, right? There's outside influences, the US, there's bond rates can move up and down. That's how fixed rates are priced. Variable rate is priced on the Bank of Canada's prime rate, and prime rate doesn't really have anything to do with the bond market. So prime rate was sitting at 2.7%. Most people get a discount on variable. Now, this is another thing, just a side note. What happens in times like this is, right, if you have a variable rate, most people are used to prime minus 70 or prime minus 80, for example. So when prime starts to move up, or there's, when we're trying to curb inflation, not only will you see prime rate maybe move up, fixed rates start to move up, but the discount on prime starts to get cut as well. So where you were maybe being offered 3 months ago, prime minus 70, prime minus 80, you're now getting offered prime minus 50, prime minus 60. Sometimes on rentals, it's, prime minus 20. So that has a bit of an effect as well with variable. Okay, so the bank will control the discount on variable, which again, that's sort of tied to the bond market, but the prime rate is not tied to the bond market. So prime rate goes up and down. If you sign a mortgage and you have prime minus 60 today, and prime today is 3.2%, you're going to be at 2.6%. So as prime increases, so will your interest rate. Okay. The rumor is prime will continue to go up. I think that's, a reasonable expectation. June is the next meeting. People are anticipating possibly another 0.5 point to 0.75 of a point. I've made so many predictions, half I'm right, half I'm wrong. So it's tough to even say these days, right? But I mean, I think 0.5 point would, do a lot. I mean, look what 0.5 point did on this. I think you could probably speak, Paul, what's the market like? Are you seeing as many multiple offers? Are you seeing as many, have you seen a reaction to the 0.5 point increase?
Yeah, it was almost overnight. I think people were kind of sitting there expecting it to happen, and they wanted a reason to be able to chill out. So really knock the knees out of the demand. So where we had 10 buyers chasing 3 properties before and everything was multiple offers, now you might have 5 buyers chasing 3 properties. So there's still it's still a bit of a seller's market for sure, no doubt. And still some things are getting multiple offers, but it isn't the the circus it was before. That wasn't anything near normal.
And that's the design, right? We have to remember that's the design of increasing interest rates, right? They're trying to curb inflation. They're trying to cool the housing market. They don't want, the same multiple offer situation bidding wars. They don't. So that one of the biggest influences you can do, of course, aside from maybe create inventory, which hopefully they're doing as well, is increase the interest rates, increase the cost, because that puts people into a bit of a panic, right? Understandably so. This is a business, it's dollars and cents. So anytime that's impacting us and our numbers are going up, it's cause for concern. Not necessarily panic, but cause for concern and a time to, reevaluate.
Quickly, the Canada's prime rate or overnight rate, you might hear that being called that too, went up 1/4 point, then 0.5 point. It went from 2.45 to 2.7. Now it's at 3.2, right? And then bond rates over the past several months have increased also. So now you have a situation where variable rates and bond rates have both increased. And at any time during the year, what Dan is trying to say, that they could go up and down regardless of each other. They don't move in tandem because of different markets move those interest rates.
Yeah, that's exactly right. And to give people an idea of where we are today versus where we were before, 3-4 months ago, you were probably around 3% on an interest rate, right? A 5-year fixed would probably run you 3%. A year and a half ago, 2 years ago, you might have been getting 2%, but about 3-4 months ago, you were getting 3%. That rate today, when you're buying, whether it's owner occupied rental, you're going to be well over 4% today, 4.25 to 4.5 on a 5-year fixed rate. The variable is still very attractive. It's come back to a more balanced sort of system where variable is lower than fixed. There was an inverted yield curve right before COVID where variable rate was actually higher than fixed rates, and people aren't really taking, that's one of the benefits of variable, right? It's lower than fixed rates. That's why we like it. Yeah. So we're back to more of a balance there. Variable rate, even though prime today is 3.2%, you're going to be somewhere, prime minus 60 to prime minus 20, depending on if it's a rental.
Yeah.
So people will say, yeah, but Dan, I don't want to go variable, right? Rates are going to continue to go up. Well, if you do some simple math and you look at like an average fixed rate today and you're at 4.5%, and I'm telling you, let's say on the high side of variable, you're going to be at prime minus 20. Let's just say that you're at 3%. So, I mean, you do the quick math, how many increases could you still withstand to your variable rate before it would cross over into today's fixed rates, right? You're looking at potentially, depending on the pace. This is the thing, it's tough to predict. We hadn't seen 50-point increases, to Paul's point, in 20 years. So everybody anticipates quarter point increases. So 50 basis point increase was a really big increase. But if we estimate that the max they're going to do is 50, we can still withstand 3 more 50 basis point increases to prime rate before it would cross over today's fixed rates. And the likelihood, again, it's tough to make predictions, but the likelihood of rates going up a full 1.5 in the next year, low, but possible over the next 2 years, 2.5 to 3 years, it's possible. So, investing becomes more about affordability these days in times like this, right? It's a time to reassess existing debt. If we're sort of limited on how much funds we can have going out, and the raising costs of capital is, going to exceed what we're willing to put out or what we're able to put out, it might be time to maybe look at restructuring existing mortgages. We have a lot of people that have fast amortizations, accelerated amortizations on their owner occupied home, which is a great thing. Don't get me wrong. We want to pay off non-deductible debt quickly, but sometimes pushing back amortizations on an owner occupied home or maybe on a rental property can help offset, again, these increasing costs, because, it's, in fairness, they're probably going to continue to go up, and it's probably going to scare a lot of people, from going into the market. It's going to do exactly what it's designed to do and slow the market. But as investors, this is the thing with investors, Paul, I think we love about investors. When the market's busy, investors get FOMO, right? They want to buy, they get fear of missing out. We got to buy. But when the market's slow, investors see that as a buying opportunity. So this is, again, an opportunity to restructure, get your bearings, and then maybe pick up, some properties that,
This is what's going to separate you from the pack. You're a few things. My goal is always to be a sophisticated investor. So what that means is, if the market's going up, I want to be able to make money. If the market's sideways, I want to be able to make money. If the market's, might be heading down in the next 12 or 18 months, I still want to make money. It doesn't mean I'm going to go hide in my closet. So if we arm ourselves with information and good information, then you can kind of pre-plan that stuff. And, if you're buying properties that cash flow, hey, you can withstand 6 months to a year, whatever, anyway. I'm just going to mute whoever that is. There we go. So I'm always with the rates, I'm always looking at the difference. So if variable is going to be 3 and fixed is going to be 4 or 4.5, in my world, it's variable all day. If variable is 3 and fixed is 3.25 or 3.5, it's a conversation, because you might want to pay that little bit to have that much security if you think it's going up in a little bit. But with the spread,
and here's 2 other really important things too when it comes to that decision. Okay. Everybody's heard of the stress test, right? We know what the stress test is, right? The stress test, when you're qualifying on a variable rate, is different than when you're qualifying on a fixed rate. So when you're qualifying for a variable rate, the stress test is 5.25, meaning I have to run a pre-approval at 5.25 as an interest rate. That's on a variable. The rule is, when it's a fixed rate, you have to run the pre-approval at 2% over the contract rate. So if I'm getting a contract rate of 4.5% or 4.25, and somebody wants a fixed rate, I now have to run their pre-approval at 6.44 versus 5.25. So something like that will lower somebody's ability to qualify for a higher number, because it's debt servicing, right? Yeah. The higher the qualifying rate, the lower the pre-approval. Secondly, to that point, on just, something separate, one thing you have to be careful of is, when rates drop, remember, when we think of penalties to break the mortgage, right? Variable rate, we know the penalty is only ever 3 months interest, right? We know that. That's what it is. Unless we went to some small lender with some no frills mortgage, most big bank penalties, it's just 3 months interest in a variable rate. But when you have a fixed rate, the penalty is either 3 months interest or interest rate differential. And interest rate differential is based on rates at the time you want to break the mortgage. So if you think about it, there was a lot of people, Paul, I just mentioned that there was that inverted yield curve that happened a couple of years ago where variable rate was higher, right? Fixed rates were going up, variable rate was higher. Who's taking a variable rate when fixed rates are lower than variable? Everybody took fixed rates. Fixed rates were 3.79, 3.89. People were locking in because fixed rates in 2017 actually went up a bit. But what happened when in 2019, 2020, when rates started to come down a bit, right? And when COVID hit, rates went all the way down to 2%. You had a lot of people coming back going, hey, I locked in at 3.79, 3.89%. And now I want to break my mortgage. I want to sell my property for whatever reason. Well, now you're going to have a massive penalty, because the bank calculates interest rate differential. If you're sitting there, if they have their money loaned out to you at 3.79% and you go to them and break it, and the rates for them to relend that money out is at like 2%, that's the bond, cost of the bond at the time, they're going to figure out, well, that's not good for us. We have you locked in for 5 years at 3.79, and we have to take a 3-year hit on that at 2%. Let's figure out what that difference is of money we as the bank are going to lose, and we're going to charge you, the client. And that's where you start to see those massive penalties of like 20, 30, sometimes even 40 grand. It just depends on the mortgage amount. It's because you're breaking it at a time where rates are lower. So be cautious in times like this. I mean, it's not a bad idea to take fixed. I'm not saying that, but you have to understand, if rates are lower in 2 or 3 years from now and you want to break that mortgage, you could be subject to a higher penalty. So those were two things I just wanted to mention.
I took a fix 2 years ago, but I took a short one because the variable was with a credit union. Credit union, Desjardins, and like the fixed was 3.2 and their variable was something. No, the fixed was 2.9 and the variable was prime +2. They weren't giving any discount, and it was plus, and it was like a 1/4 point difference. I'm like, screw it, I'm just going to take a 3-year fix. So I took a shorter one. I'm like, okay, if things happen, it's not 5 years at least.
Yeah, you can try to time it with things like that.
Yeah,
for sure.
Yeah. No, that's good. Now, so the fundamentals don't change. If we're out there looking for cash flowing properties, if we're looking for value add properties, you want to build a basement apartment, you want to do a BRRRR, you want to do a refinance, whatever it is. And we're just our formula and our conversation regarding what financing we're going to have today and for the next 3 to 5 years is just going to change, right? But luckily, we're having more inventory and prices are sort of stabilizing. In some cases, they're wobbly a bit. So, I'm not having a conversation when I'm picking a name here, Andrew White. I'm not saying, hey, Andrew, sorry, you got to pay, 120,000 over asking. I'm saying, hey, now we're paying list price, or maybe 10 or 20 over, or 10 or 20 under, right? So, yes, you're going to pay a little bit of a higher rate, but you might end up the same because you're not paying 100,000 over asking.
But and that's why affordability becomes so important. People will, nowadays it's tough, Paul. Like, you've been doing this for a long time, so have I. It's tough. It's tough in the GTA, especially, to make cash flowing properties, right? Unless you're buying multi-units, duplexes. It's even getting tough on duplexes, but triplexes for sure. But single family, it's very tough to make the cash flow. So that'll steer a lot of investors away from investing, right? Hey, I can't take on a property where it's bleeding $50 a month. That's not good for me. I can't take on that investment. But the reality is, again, you have to look at your overall expenses, right? We spend a lot of time sitting with people now that have car payments, $700-800 a month. They have lines of credit payments. They have highly accelerated mortgages because they're trying to pay it off quicker. So you have to think sometimes big picture when it comes to investing. I mean, you always want to think big picture when it comes to investing. But restructuring your existing debt load, sometimes paying off cars, lowering payments, can still afford you the ability to take on these investments. Because the one thing we believe in real estate is, although the market may flatline or even, dip, much like it did in 2017 a little bit, right? It rebounds. That's the thing we like about real estate. If you look at the history of real estate, it's not a question of if it will rebound. It's more of a question of when it will rebound. That's the question. So how long do we have to, last where properties will start to come back? Well, if you look at the supply and demand issues, like, I don't know, I don't really see them solving it. You're going to turn a lot of, fringe buyers into non-buyers, and you're going to turn a lot of people who choose not to pay the interest rates and would just rather go to renters. You're going to fish out a lot of those, but the housing supply isn't going anywhere. This is the one thing you can't take away from economics is supply and demand. And we have a massive influx of immigration still coming. We still have a shortfall. There really is. They've announced, this is what they do. They announce they have plans to build more housing, but yet we don't see that coming. So when it's here, yeah, it's coming, and we're all waiting for it. We're coming. I see a lot of apartments going up, but raw land, it's very tough to get. I mentioned 2017. I bought in 2017, right? Me, the mortgage broker, I bought at the peak of 2017, and my appraisal came in low. Right when I bought a house. It was an owner occupied, and my appraisal came in low. And I spent a lot of sleepless nights trying to figure out how me, who's been doing this for 15 years, could have made such a bad decision of buying at the peak of a market. But here we are 5 years later, and I look back, and it's like, what does it matter? Just like any of you, if anybody that owns houses now, that 17, had I told you, well, you probably could have got that for $20,000-$30,000 cheaper had you waited a couple months. You're looking at it going, it doesn't matter now. All that matters is what's it worth today. And that's why we love real estate, right? The worry isn't that the market's going to drop. That's not the worry for us as investors. The worry is that if the market drops, we're going to have to sell our property at a loss. That's the risk. So the market dropping has little influence to us as investors unless we're selling, maybe refinancing. But on the good side of things, it can help us as buyers for sure.
Yeah, if you're sitting on the sidelines with capital, this is a great time for you because your ability to shop inventory just went up by like 3 or 4-fold, right? So you can take your time and really, choose the one you want, or at least it's a lot better than it was before. And along with maybe knocking out the bottom 10 or 15% of buyers because the rates have increased, those people, if they can't buy, they now become renters. So you just increase the renter pool also. And we all know we have a very limited supply of rental units, especially good ones. So I expect rents to continue to increase also. So what did you say, $30 per every 100 grand?
Yeah, about that. Yep.
Even if it was $50 per every 100 grand, right? And you can do the math. It's definitely an increase, and it comes on your bottom line. But if you can get a unit vacant that you've had rented since 2018 and raise the rents $400, well, then never mind, you're covering your cash flowing. So we don't want to be stuck in fear. We want to be solution oriented here. We might have took a little hit here, but let's look at all the places we can find some extra cash flow or find an extra unit. Maybe we can build a garden suite. Maybe we can do something in your basement you already own, right? We got to be solution oriented, I think.
I agree 100%.
I got a couple questions come through. I have 2 mortgages that were coming up for renewal that were on 1-year fixed previously. My question is, how do I ensure that the bank offers me a variable rate on my renewal?
Okay. Yeah. So assuming it's a lender, most A lenders will start the process of early renewal within 6 months of the actual renewal date. Mm-hmm. So very simple. I mean, an email to your bank rep or whatever would be the best way to, have something, because sometimes what happens is people don't pay attention to the renewal date, and then the renewal happens and they just get locked into a rate that they didn't even know. So if you want to avoid something like that, what you would do is email your bank rep and have something on record saying, on renewal, I would like my mortgage to be renewed into a variable rate. Now, if you're looking at a B lender, there's not much you can do, to be quite honest with you. B lenders don't offer that sort of early renewal program. They just don't. You have to wait till the end of the term, and they'll offer you a renewal, usually within 60 days of the renewal date. So you'll pick from whatever offer they send out. But there's no way, that's the thing. There's no way to lock in those rates early.
Yeah. Okay. Now, I just want to speak to those who are probably sidelined or kind of waiting to see how things will go. And I'll just tell you kind of what I'm doing. we just sold some stuff and we're uh, maybe conserving some cash to see how the next few months kind of ride out. To me, if they raise interest rates a quarter point in June, like I don't see that as making a huge difference, to be honest with you. And if we run into summer and things are still the same, I don't think it's going to pick up tremendously over the summer. I think people are going to want to enjoy their summer and be on vacation, especially with the long winter we've already had. So if they leave rates the same and we see some stability, you could see inventory, or excuse me, activity starts to pick up all the way near September. But this time between now and then is fantastic for us who want to be out there looking at deals. So that's what I'm doing for myself. I feel like it's my turn. Finally, I don't have to compete with 500 other people. And never mind MLS stuff. A lot of the stuff I'm looking at is not even on the market anyway, and I'm still competing. And I'm like, this is insane. It's not supposed to be like that. So I'm kind of licking my chops, and I'm, at the opportunities here. And I'm not trying to push you guys to do something that you're fearful of, but I'd rather you be informed and make informed choices and say, hey, I'm going to sit on the sidelines because of this, this, and this, not because I heard some news article on CBC, right? That's why I wanted Dan to come here and talk. Now, question, as variable rates go up, is the discount locked for the length of the term?
Yeah, the discount is locked. So if you're offered like prime minus 60 on your contract, you're going to get prime minus 60 through that contract. Yes.
Got it. Let me just pull up one more point I wanted to bring up here. So Dan, from your end, are people still choosing variable over fixed right now by the majority?
Yeah, an overwhelming majority of people prefer variable over fixed rate. Most investors, like it's even more so. I mean, 95% of investors will start off with variable, and then maybe like 10 to 20% from there will go and lock that variable in at the sign of rates going up. But most investors have been doing this long enough that they prefer the options of variable. Remember, your mortgage isn't just about rate, right? You have to know your options. What's my plan? If it was just about rate, well, you might end up at a small lender where they don't give you access to equity down the road. So rate is just one part of the equation when you're negotiating. You have to, you want to understand amortization, re-access to money, all that stuff.
So people are not rushing to lock in rates at this point.
No, and that's the thing. Most people really think, if you're getting, for example, if you're getting prime, let's just use my example of prime minus 20, because it's just easy numbers for me, right? 3.2 minus 20. So if you're getting that as an interest rate, people will make the assumption, well, oh man, I got to lock that in before rates go up. Well, remember, you're not locking in your variable rate to 3%. You're locking your 3% variable rate into today's fixed rates. And today's fixed rates are closer to 4.5%. So when people may think, like we get that all the time, we get an email, hey, Dan, should I think, is now the time to think about locking in? And that's a very normal question. But my answer to them usually, because again, comfort, and lifestyle plays into this a bit. So it's always the client's decision. But once I sort of give them what the fixed rates usually are, you have to call your bank specifically, but when I give them the number of, what they can expect, to most people, it's a no-brainer. It's like, well, I'd rather just wait now and see if rates go up another full 1%, I'm still going to be lower than what today's fixed rates are. And that's right. So that's why I'm like you, I would favor variable. The only way I would go fixed rate right now is, number one, if I knew I wasn't selling it 100%. And number two, that rate would have to be pretty attractive right now. I'd have to be like somewhere around 3%. And that's just not available. Maybe, on a shorter term or variable, but certainly not on a fixed rate.
Fantastic. This is exactly the conversation I know everyone's having in their head. Now, let me see. I was going to show you a couple deals that we just did for people and that came in below asking, but they're not firmed up yet. So I don't want to do that. I don't think it's fair to them. I don't want to jinx them. So we'll do that another time. But I want to, before I ask you any questions, I want to ask the crowd, has anyone been able to get anything done under asking in the last couple of weeks? I don't see anyone that we're working with on here, like in the moment. but if anyone wants to share, I'm looking for the data for sure. No. Okay. So let me go back to my questions here.
People aren't, again, I date myself. I've been doing this for 20 years, but it's like, I remember when like 30 days on the market was normal. People now, if it's been on the market for 30 days, people are like, what the heck's wrong with that house? 30 days, that's insane. But that's a normal market.
We used to say 30 to 60 days.
Yeah, 30 to 60 days. Yeah, that's normal. If something went right when it was listed, it would be, that was crazy. Like, oh, you got an offer already. Wow. It's only been on the market for a week. Amazing.
So Joanna's asking, when you renew with your existing lender, and this lender is a credit union, can you negotiate the new rate they give you?
So yes and no. So yes, you can, of course. I mean, you can, sometimes when you're with a credit union, there's two different types of credit union. Credit union that does like A type lending, which is like a Meridian. They have a pretty good rates. They have some limitations, but they have good rates. And then there's B lenders that are like credit unions that have a little bit higher rates, and they sometimes come with fees. So I'll talk to both points. If you're on the A side of it, absolutely. I mean, that's like any negotiation. If I'm with TD or RBC and my renewal's coming up and they're offering me a rate, I can tell them all day, I'm getting offered this from Scotia, I'm getting offered this from BMO. I'd like to see if you can do better. Okay, so you can absolutely do the same sort of negotiation if it's with the credit union. Now, if it's with a B lender, okay, the challenge sometimes with the B lender is if you're with a B lender, you've paid a 1% lender fee, right? At the start of that mortgage, that's called new money. When you take in new money from a B lender, they charge you a 1% lender fee on the loan amount. On renewal, they waive that lender fee. There is no lender fee. So after 1 year, you can renew with them and you don't have to pay that lender fee again because there's no new money. However, you're limited on negotiating with the B lender. Why? Because for you to take that mortgage and move it to, say, well, if you're moving it to an A lender, great, you're going to get a better deal. But to shop it between B lenders, if you move it from one to another, you're going to pay that lender fee again at the new lender. Right? So rate, you just don't have a ton of negotiation if it's a B lender side of things, but whatever, I would say, give it your best, throw the Hail Mary, tell them you're getting a better deal and see what they'll come back with. Usually they will, they'll maybe 10 basis points or 5 basis points under, but I would certainly attempt for sure. It's tough to negotiate with them because you leaving is going to cost more money because you're paying that lender fee right away.
You can try with the credit unions. I tried. I mean, they told me to go take a hike, but you never know. Maybe they don't like me.
Yeah.
Now, do B lenders or credit unions do stress tests?
Yeah. They their stress test is a little different. Again, they're 2% over the contract rate on fixed rates. So, but they have way easier like underwriting guidelines. So despite their qualifying being higher, generally you can qualify for a higher number with B lenders.
Yeah. Now, I want to hear your answer, and I'll answer too. Are private lender rates, short-term private lending rates, also rising? And do these move with variable or fixed rates?
No, it moves with the market. Good question, though. But private lender rates definitely reflect the market. I mean, where we were getting like 6% on private lending, you can expect pricing like that to go up for sure. I mean, that's what happens in the market. When we're acquiring real estate and we're taking on mortgages, the pricing is very simple, right? A lender is the best, B lender is the second best, and private lender is your last option. So they price themselves in parallel to that. A lenders are going to be your cheapest, B lenders are going to be a bit more expensive, and private lenders will be more expensive than that. So that trend will follow for sure. One thing that they've sort of announced is more regulation coming to private lending. People like myself, mortgage brokers, you're going to have certain criteria. You're going to have to take certain classes, because one thing that happens, when a market is so hot like real estate, it attracts a lot of fast money. And for those who play the stock market, you might understand what fast money is. It's when there's a lot of money that floods to the market because it's on a real run. So a lot of money comes in, whether it's flippers who want fast money, get in, get out, get my money in, get my money out, or it's the other kind of money coming in where I literally had this whole thing I was thinking about. I just lost my train of thought, but hold on, let me rewind. What was I just talking about?
Fast money.
I know the fast money, but I had a point to that. I was talking about Man, I lost it. That
That's okay.
happens to me every once in a while, but I'll get it back and I'll jump back to it. My
Give me the
point was,
phone.
it was about, yeah, the fast money coming in. Oh, on private mortgages, more money comes in. That's like that's another version of fast money. That's what I was saying. There's a lot more private lenders that come into the market trying to lend, because private lending is all about risk and it's all about equity in a home. So when prices are going up like crazy, what's your real risk? If they don't pay you, well, the house has gone up so much more. Even if I sold it at a discount, I'm getting my money back. So that's considered fast money. But one of the first things that happens when there's uncertainty in the market, number one, fast money tends to get burned quickly, because they're not the long-term holders, right? They're the people that are coming in and getting out. So if you're getting in right now and you're doing a flip and now you're stuck trying to sell that, Tom and Nick have been in that. They talk about that in the very first class at Rockstar. They talk about being in a scenario like that. So private lending is becoming tougher, because people like me will have to have licenses to do private lending. There'll be ongoing certificates, and the cost will start to go up because that fast money starts to pull itself away in a more stable market. There's less people throwing their money in the real estate because it's not generating the same returns as it was before. It's not as safe in a sense because it's not going up so much. But if you understand real estate, if you understand private lending, it's still a great way to make money. There's still, benefit. I've always worked on a 5% increase on real estate value. But, so if you work within those parameters, you can still be safe. But it's a long answer to your question. But yes, rates and costs will inevitably go up with private lending for sure.
Yeah, our construction financing we're seeing stays the same. I mean, that doesn't really change, at least on our end. And I haven't gotten a private, at least a big one, in a while. So I'm that your answer makes sense that it's going to stay in tandem with everything else that's moving also. All right. So let's put through the other questions. Otherwise, I just want to talk more about kind of what I'm seeing in the marketplace, and interrupt me if we have to. And if we don't get any more questions after this, we can call it. But put your questions through or unmute yourself if you need to. So we've done several transactions in the last little while, and I'm seeing more off-market properties finally kind of come back to the table. I mean, realistically, when things were as nuts as they were, in a lot of ways, it was a disservice for you or for me to offer your property off market, because if we went to MLS, there's a good chance we would have got 20 offers and some crazy number over asking. Things are where they are now with some uncertainty and a little closer to balance. It starts to make sense for investors to offer their properties off market again. And within a week, I had 3 people call me and say, "Oh, I have a triplex," or "Oh, I have a duplex." And I had been seeing much less of those calls in the last 12, 15, 18 months even. So start to expect that we're gonna have more inventory off market for some small stuff, and for bigger stuff for those of you looking for multifamily. So that's fantastic. And we always want to have that stuff in our back pocket, because most times the investor or the landlord who's selling it, I mean, they're going to want the money they want, but they're going to leave some meat on the bone for the next person. You can't really sell a deal that looks terrible on paper off market. No one's going to touch it. So if they're coming off market, it's usually coming with some decent numbers to work with and a good opportunity, right? So we've done a few of those, and a couple deals off MLS, and no multiple offers. And it was almost weird. Like, I'm used to calling and saying, "Do you have any offers?" And no. I'm like, "So I can just send you an offer right now?" I'm like, "Yeah." I'm like, "All right." Like, when do you want the irrevocable for? I haven't asked that question in 2 years. So yeah, we submitted an offer with an irrevocable, and they replied back to us. We got a counter offer back. Can you imagine that? And we got a couple deals done that way. So to me, even though things are uncertain with interest rates, it's a lot better atmosphere for buyers out there. So you're going to get better deals for yourself, and you're going to be able to see much more inventory. So that's all a positive. If you can take a positive out of here, we don't want to, make everybody scared about rising interest rates. And just to remind myself also, I wanted to mention, like, this stuff with interest rates, it's all cyclical. I remember what year was it? It was early on, and I think my second or maybe like 2012, 2013, rates were increasing. Fixed rates, or yes, fixed rates were increasing. And I had a call with Dave Butler, and Dave's like, man, you should lock this one in. And then we made a bet. I think he still owes me lunch on that one. Because it kind of went up and then kind of went down again. You know what I mean? So who knows? And who knew what was going to happen in 2020? If something crazy could happen again. We could have war with Ukraine. We could have war with China, and all of a sudden rates go right back in the toilet again. Right.
Well, that's just it. I didn't mean to jump in, but it's like, you nailed it. If we were predicting in 2017, people were saying that's the end, rates are going up. That's the end of low rates in Canada. Yeah. So a lot of people locked in. I think I even told my brother to lock in, like, for sure. That was the advice to do. But, 2019 hit, COVID hit. And when there was fear of a recession in Canada, one of the first things the government did was lower interest rates, right? They want to keep people spending. They want to keep the market going. They want to keep people strong. So the economy was pumping. What they realized is 2 years later is, with all these people sitting at home, right, without the ability to go and spend money at things that they're maybe used to doing, going to cottages, going on trips or things, what did they do? They bought real estate. That's what people did. People went and realized, I don't want to live in a smaller apartment, or I don't want to live here. I want to go buy real estate. So the spending of all that money they kicked in to the economy just got spent on real estate. And that's what drove up this market. So you're having the opposite effect now, right? Which is the market's gone out of control. So 2 years ago, when they were saying, I think it was the US Fed was saying, we're not even thinking about increasing interest rates, yeah. Right? Well, you say that, and then when the market's out of control, they go, okay, well, we got to get this out of control. We're lowering interest rates. But expect a similar thing, right? This is the game of finance, right? If there's fear of it's possible. Listen, like Paul said, anything can happen. We don't know the future, but I don't believe anybody's trying to crash the market. I think what we're trying to do is bring balance to the market. And I think once the market, reacts to this recent increase, another increase, you may see rates start to level off a bit. I'm not saying they're going to be dropping anytime soon, but that's why, again, investing these days is just more about affordability. And I'm not pushing anybody to go and buy, but I'm saying don't make decisions until you've run your numbers, until you understand the cost, that's all.
Yeah. Realistically, I know a lot of you on here, you're all much more experienced than the average, investor out there, especially if you're watching Daniel and I all the time. Ha ha ha. So really 0.5% or a 0.75% move, or even a 1% move isn't going to make that much of a dent. It's just about getting the right information so you can make better decisions out there. So one more question. Do DCR loans exist in Canada, or is it solely TDI and total
TDS? Yeah, no, it's mostly TDS. They do exist, but you're going to have a hard time getting a lender to strictly approve you on rental income like that, like portfolio lending. It's very difficult. The portfolio has to be performing pretty strong to get that sort of a loan. They're looking at you personally. Like, that's the reality. Even when buying under a corporation, most banks are looking at you personally. The income of the corporation, which in most cases isn't performing well by design, right? If we have a real estate portfolio that's performing strongly, we may be paying tax. So most people, it's not performing well. Thus, that corporate structure of buying properties doesn't normally work. So to answer, it's sort of a wishy-washy answer. Yes, they do DCRs. There's a couple of banks that will do it, but they're also going to take on your personal application. They have limitations on, remember, their DCR is also based on limits of lines of credit rather than balances. So it's not a true DCR in terms of what's the expenses and what's the liabilities. Every bank is different on what they consider liabilities.
Yep, makes sense. Let me see here.
I saw one question, Vineet, my guy Vineet. So Vineet, to answer your question, the question on the side was, do lenders, when you're self-employed, you can pay yourself different ways when you have a corporation. So let's say in 1 year, if you paid yourself a T4, and then the next year you decided to pay yourself a dividend. The question is, will a bank consider both sources as income for you? Well, the rule, and banks love rules, the rule with the bank is you have to have a 2-year history of filing the same income. So for example, if you're paying yourself T4, the rule is the bank wants to see a 2-year of T4. If you're paying yourself a dividend, the bank wants to see a 2-year dividend. However, if this happens a lot, right? Realtors were self-employed. They were just able to build corporations, I think 2 years ago. So a lot of realtors went from like a sole proprietorship, paying themselves a net income, to then paying themselves through a corporation on like either T4 or dividend. So as long as you can provide the bank a reasonable explanation as to why it's changing, they will make exceptions, right? So if I go to them and say, look, Vineet was claiming he paid himself a T4 of X amount in 1 year, and then the next year his accountant told him, no, you got to do it in dividends, they will. That's both taxed income. So they'll usually just use a 2-year history of the two of them combined, divided by 2, and that'll give you your average. That's usually how it will work. However, the rule is a 2 years from the same source.
Thank you, Dan. Now, we don't have time to cover all the questions, but Dan, what's the best way to get a hold of you if people want to reach out and talk about refinancing or restructuring or a new purchase or all that kind of stuff?
Yeah, they can email info@bmselect.ca. I can get one of my team members to connect with them. I mean, we typically, with investors, for those that don't know, we're a bit of a different office, and this gives me a bit of an opportunity to maybe explain for those that don't know how my office works. Most mortgage brokers sort of operate in a way where they will meet the client up front, they collect the documents, they input it, and that's a pretty normal brokerage. But we actually work in a bit different way with investors, as we find, most investors are coming for the same thing. They either want to restructure their existing properties or they want to get pre-approved to go buy more. So we've built a bit of an office, a bit of an infrastructure behind me. I have a pretty good staff that helps collect paperwork, organize files, but we're very used to setting up one-on-ones for any of your investor. With myself or Paul, Mike and myself usually will meet with investors to review like a whole portfolio analysis. So if there's anybody out here that's looking for that, that's maybe looking to get an idea on pulling equity out of their properties, getting a pre-approval done to go buy more properties, email myself at info@bmselect.ca. My team will take over. We can collect all your information. We can set up one of those one-on-one meetings. But if it's just a phone call, if you'd like just maybe a 10-15 minute, intro call or have some questions, send an email. You can request that as well. And I can definitely set up a call with Mike or myself.
Yeah, no problem. Thank you. I'll when I send the recording out to everyone here, I'll include the email address for Dan. I'm sure you guys know what I do. I won't spend a lot of time telling you that, but for those of you who are new or who don't know me, I'm the guy, when you're driving down the highway, you see my billboard that says list with me. No, I'm kidding. No, we're obviously realtors, but we don't do the residential thing. Like Dan, we're focused on working with investors, right? Which is why all our content is around good, valuable resources like this for investors. That's kind of what we do. And like Dan, we have staff and teams that work for us that allow us to talk to and speak to and handle all the transactions that we do. Because I would spin around in circles and never sleep if I had to do everything myself. So if you do need help, you know how to get a hold of me. You'll get an email from me anyway. But I want to thank Dan and thank you all for joining, and thank you for those who are going to listen to the recording. I hope you got your questions answered. Talk soon.
Thank you all. Yeah. Thanks to all the familiar faces. I see a lot of my clients in here. It's such a treat. It's like, and I think, or was it, who somebody mentioned, the chat's moving, but somebody mentioned in the chat, oh, this saves me a phone call. I'm like, oh, perfect. There you go. That's exactly what we're trying to do. So that's awesome.
All right. So many thanks from everyone.
All right. Thank you very much, everybody.